Patanjali Keswani, Chairman and MD Director at Lemon Tree Hotels, joining us on board right now. Remember, the IPO opens today, so let's chat about that a little bit more. Mr. Keswani, your PAT margins have improved from negative 10% in FY13 to about negative 2% in FY17. But tell us if you will see a sustained improvement in your profits. Is that what you foresee?
Like any cyclical business, when creation of supply puts, especially when supply is greater than demand, it puts pressure on pricing, and pricing keeps either remains stagnant or increases very marginally. As a result, the economics of that business deteriorate till a point comes when no fresh supply is planned. So India was at that position for the last 3 to 4 years. So if you read my RHP, you will find that we've commissioned an industry report from HTL, which is one of the leading global consultants in the hotel business. And they very clearly project that for the next 4 years, India is going to go through the reversal of this cycle, which means demand will be far in excess of supply. So what happens then is pricing typically shoots up. Now, I don't want to give very forward-looking statements about Lemon Tree, but let me just say this, which is that our business, the hotel business, is one where the hotel assets appreciate over time. So really the numbers you look at are not PAT as much as cash profit, which is really PAT plus depreciation. And we have always been, except for 2 years where we were very marginally cash negative, we have always been very cash positive, and which is why we have grown so much.
So how is it that you will navigate a very tough competitive environment in the management contract space? The share of online travel agents has increased in the company's overall revenue contribution from 9% in FY15 to 20% in FY17. But do you think this trend can be maintained?
I hope so, because if you look at it, say in the US, 50% of the business is online. Now the point is, how do you treat online travel agents? So firstly, I think the question you asked me are two separate questions, because competition in the management space is very different to online travel agents, because they are a distribution channel for you. So let me come to the online travel agents first. So fundamentally, online travel agents are your partners. Of course, they take a commission for the business that they get you, but they provide an additional distribution channel for you. Now, as I was saying, if you look at the United States, I think over 50% of the total business for hotels is booked on online channels. In India, it is still, I think, less than half of that. For Lemon Tree, 27% of our business is online, 7% is through our own website, and 20% is with online travel agents. I see it as a positive trend, because we are ultimately partners in creating awareness and usage of the mid-market hotel sector. Sure, there will be disagreements on how much commission should be charged, but I think ultimately among the larger players there is some, well, I would say, financial rationale in how we distribute that. As far as management contracts go, I don't think there is so much competition in that space, primarily because there is not so much supply. Going forward, I think I do expect this space to consolidate. There will be 2 or 3 or maximum 4 players in the mid-market space, and they will be the dominant players who offer owners, management contracts and branding opportunities. And competition, of course, to that extent will continue, but I don't think it will be destructive in any way.
EBITDA margins have improved as OPEX has reduced versus revenue. What is your outlook on margins?
So, broadly, as I said, I don't want to give futuristic statements, but broadly, let me make the following observations. If you take a hotel cycle, which is typically 7 to 10 years, in 2 to 3 of those 10 years, you make over 60% of your profits, because that's the time when your pricing really shoots up, and that's the time when you get the double whammy effect, which is you sell more rooms at a higher price. Our business is mostly a fixed cost business, so the operating leverage is very high. If I take prices up, there is no increase in costs. The prices flow straight through to the bottom line. And well, when you look at our economics and you look at our uh, uh, operating margins, yes, there have been significant increases, not because, interestingly, prices have gone up, because in the last 5 years, prices have hardly gone up. It has been because so many of our hotels have opened in the last 5 years in the bottom of the cycle that they took 2 to 3 years to stabilize. So really, if you look at our economics in the last 5 years, it is that we have opened 40% of our total supply in that period. Those hotels, when they opened, took typically 2 years to stabilize. So they were, in that sense, a drag on our profits. But if you look at our RHP in the last 9 months, the first 9 months of this financial year, we've been PAT positive, we've been cash profit positive, and that's fundamentally not driven so much as by improvement in industry economics. It has been driven by the fact that our hotels have gotten stable. It is also true that our RHP reflects a 9% increase in prices in the first 9 months of this year versus the previous year. But actually that is on an aggregate basis. We really increased our prices in September and October last year. And if you look at it from that perspective, obviously our price hike in Q3 of this financial year has been much more than 9%, and it can be worked out what it was likely.
So you have a very low F&B share, that's 20% of your revenue. The peer comparison is about 40. Why is that?
So let me give you an analogy. The normal, in our business model, 75% of our revenue is from rooms. And I think in the rest of the sector, it is 60%. This 15% difference enables us in our business model to get a much higher operating profit. So I don't know where this thought has come that F&B is a high margin business. That is, well, it is independently a good margin business, but the sale of rooms is the highest possible margins. The contribution is 95%. Or put another way, if I sell a room for 100 rupees more, 95 flows straight through to my bottom line.
Okay, there's continued capex though in new room additions, which implies the company's free cash flow to remain negative. When can we see a turnaround here?
Cash flow in our business comes from three distinct sources. First is stable operating hotels. So when you look at that cash flow, it is from the hotels that have been operating from 2016 and before. We have significant cash flows from all these businesses. Then we have hotels we've opened in the last 2 years. Those are new hotels. They have still to stabilize, so their cash flows are either at break even or can be negative, and therefore we have to support them till they become cash positive, because as you know, the hotel industry is a capital intensive, long gestation business. The third is the consumption of cash flow into investing activities. So we don't need to mix the three. Let me put it this way. If you have a business where 90% of your hotels are old and you are growing at the rate of 5% or 10% and deploying your cash flow, that's a slow growth business which will always be cash positive. In our case, we deliberately followed the reverse, which is that we kept growing at the rate of growth of generation of cash flows. And we kept redeploying this. So in that sense, we were a business which didn't look at giving dividend in the last 10 years, but rather looked at redeploying whatever free cash flow we got from stable operating hotels towards supporting new hotels and towards building new hotels. I do not see us at all stressed in any form whatsoever in the past, nor in the future with our growth platform, because we are adding 3,000 rooms in the next 3 years. And I'm very comfortable with what I expect will be our ability to service any debt that we raise. And please, in that sense, look at us as a business which will actually be fully operational in the next 2 years, when all our hotels are up and running and stable.
Okay, but will the room inventory market share in the mid-scale segment sustain over FY 17 to 21 at say 7 to 8%?
We have 4,700 rooms. The mid-market space in India, according to the Harvard HTL report, as of 2017 was 53,000 rooms. So, well, I'm taking a different time period, which was a year ago, but 4,700 rooms over 53,000 is roughly 9% of India's mid-market space. That's what we are at today. If you look at the HTL report for FY21, they say that there will be roughly 78,000 rooms in India by then, assuming every single mid-market hotel which has been planned / is under construction will open. At that point, again, if you look at our RHP, we will have about 7,735 rooms. So by FY21, assuming every single hotel in India in the mid-market space which is under development opens, we will be about 10% of the market. In an extremely fragmented market like the hotel industry, I think that's a pretty good number to have. And it also will enable us in certain micro markets to have what we would call some degree of pricing power.
Okay, Mr. Keswani, many congratulations for IPOing and good luck with that. Good to speak with you and gather perspective on what the company may be headed in for.